Let me bring this show back up. Oh. Here we go. Okay. And this is the agenda as we have it, and it doesn't change year to year. It pretty much stays the same. We're going to talk about our operations and our portfolio growth, our track record, see if there are any changes to our track record. We'll talk about portfolio and financials, and I probably need to turn this way and look this way, folks, because I've got to talk into the phone. And then goals and challenges. What happened last year, continued growth of the fund, how we're maintaining and growing our yields, and ridding the balance sheet of unproductive assets profitably. So just to review our operations, and it looks a little convoluted, but if you could see my cursor, this is us. You're sitting in our facility. We're Reprop Investments, Inc., doing business as Reprop Financial. And for our investors, we take care of all the facilities, the human resources, product development, all the expenses. Said hi to the janitor last night while I was working on the slideshow. What Reprop gets is it really to its stockholders, it kicks off dividends and profits, which is an appropriate time to mention that as of a little earlier today, Dane and Emily became part of the team, and they are now Shelley and my partners. So congratulations to both of you. As you know, we do manage non-fund investments. I'm going to get a pointer out and laser. And so these folks will be here later. Boy, that's not very good. But what we do is we manage loans that folks are in. So how many of you have investments outside the fund with us? Okay, most of you. So you know what that's like. And you know we fractionalize these loans in most cases because many of them are very big. That's how we get our loans either for the fund or for our investors outside the fund. We can strike a $3.1 million deal in 4 days. And so if a wealthy investor needs that kind of money, which they did, in one case, we were able to deliver that money to them. I flew up to Portland, very wealthy individual, needed to close on 2 deals, one in Bandon and one in Medford, had to have the close in following 4 days, 4 days. It was 4 days, so it was 4 days start to finish. Unfortunately, that loan paid off. You'll see it dip in our portfolio when we get to the next slide, but that's what we do. And we have those kinds of investors all over. And then you participate in those loans either in the fund or outside the fund. And then, of course, there is the reason you're here is because of Reprop Financial Mortgage Investors, LLC, which we always call RFMI. And it holds, you all hold memberships there. $1 equals 1 share. It's a mutual fund, essentially, but it's a mutual fund of our product. We are, so if you have $100,000 invested, you have 100,000 shares. And what happens is you just get our profits after we take a management fee, and that's really what we've done through the years, is take management fees on both ends. So really, the way in which we derive income is based on your success. If we have a loan that's not paying, we're not getting paid. Then you'll see a TBD on the screen, to be determined. That is, we're going to probably get a small credit line, a warehouse line for the fund to manage cash. Right now, the imposition is on me and the company. Our goal is to have as little cash in the fund as possible, because cash in the fund doesn't earn a yield. It's just like a property we own doesn't earn a yield. We pay taxes on it. We want to rid that. So each month, we say have a big payoff, well, then Glenn is pulling money out of the fund, and the company's pulling money out of the fund, and we're managing money, our funds like that, so that we can maximize your yield, and my yield as well. I'm the largest member of the fund. But that's not efficient, and it's not a good use of Reprop's money or Glenn and Shelley's money. So what we are going to do is get a facility inside the fund to manage that cash. And so when we make a new loan, we'll be able to bring in, we'll borrow up, and when a loan pays off, we'll borrow down.
Just to add on, last year we talked about it, that it was on hold, and what we'd seen out there was bigger than our comfort level, meaning if we took on $10+ million in credit, would we be able to fill that? And we weren't confident that we could while maintaining our payoffs and our other investors. There's a local financial institution that we have talked to that we can get in this somewhere around $5 million, which is a lot more comfortable for us to do, as well as operate more of a line of credit, so we can grow into it without paying non-use fees or feeling the need to fill that line of credit and making loans we shouldn't make.
So non-use fees, by the way, is if you get a larger facility like we used to have, we had a $50 million facility at one time, then when you don't use the money, you're paying for it. You're paying a fee. It's a negotiated fee. It's not like 5%. It might be what we call 25 basis points, 50 basis points, which is 0.5% to 1%. But there's two reasons we don't want a large facility now. One is we've just invited retirement plans to the account, and what happens is it's a great thing, but you earn unrelated business tax income, something called UBTI, when we use leverage. So if we have $100,000 in the account and we have $1 of leverage, that $1 of leverage is taxable. However, if the amount of tax UBTI is under $1,000 per member, which we believe a small facility would keep it under that threshold, then you would not have to report, and you wouldn't have to file what's known as a Form 990, and we didn't want to burden you with that. Remind me to bring up REIT, because we did not cover it. I just realized we don't have a slide for that. So here is our portfolio growth, as you can see. I circled the little blip there, the $3 million little blip on that payoff that we recently had. But you can see that we're growing in all directions. Let me move this, if I can move this. I cannot move that. So the non-fund portfolio is down at the bottom, and it had been fairly stable non-fund is the black line. And that is the one that we've continued to grow, and we have been growing the fund assets as well. And our total portfolio, when you add them all up, is about $61 million now. At our height, when we had about 38 to 42 million extended on our line, we were at 71 million. So we are now all equity. We have way more equity than we used to because about 42 million of that was debt. Yeah, please.
So on this slide, you can see at this time last year, the fund stood at 16 million. We are now, as of May 31st, just over 19 million. That blip is the Emert loan. It was in your memo. So we did touch at 22 million since it's paid off. One thing you'll notice, we are up 3 million, and we will touch on this later in the slideshow. We have had a shift of investors from the trust deed side to the fund. Part of that is because we have opened up to IRA funds, and part of that is we've opened the fund up more so to new investors, or existing investors, but to take new investments in the fund. What you'll see on the black line, which is our trust deed side, when we had this meeting last year, we were at 43 million. And then what seems like Armageddon hit, and we had so many payoffs. And you can see the dip in our portfolio, both there and the top line, which is our total assets under management. We will touch on that later about how many payoffs we actually received. The shift from the trust deed to the fund it's a lot of our existing investors, and so we've been able to grow the fund.
The main reason is people, you all know us by now. We're not going to make a dumb loan, and that's our reputation in the industry. So what that leads to is money on the sidelines, and so not earning anything. And so some folks kind of balance that against, I got all this money on the sidelines, and I really don't want to take my returns, so I want to reinvest my returns, and that's the other problem is we're regulated differently on the trust deed side. The Department of Real Estate regulates us on that side. On this side, we're not regulated by the Department of Real Estate, and we're required to pay out any earnings, any principal we receive monthly on the trust deed side. Going on to the next slide, this really hasn't changed to the worse. We still have those two losses. It's covered by... It didn't turn. Oh, it didn't turn. I apologize. I'm a little trouble advancing these slides. Okay. Nothing's changed. We still have those two losses stemming from two new construction sites near Big Bear that's forever ago. We have a judgment. It is bankruptcy proof. It's a matter of moving on that security. And it just sort of has been one of those things where it's capacity, and it's a collection effort. I have another collection effort I want to take care of before that I'll talk about later that's in North Carolina. That's a lot bigger bucks. And that's $500,000. That's a $503,000 judgment that you own. And that's the one I want to move on. It's seasoned up nicely. I know that the party we have the judgment against is earning money. We don't know about this fellow Swanson. This is our diversification by state. One thing that Dane notes is our Oregon-based loans are really growing. They're a little bit more profitable. We generally get about 1% or so more on those loans because the market, California is unbelievable in terms of, especially Southern California. In 2012, we owned Southern California. Nobody else had money. And we were doing our best for best program at 599 and 699, which we couldn't do today because the cost of funds have gone up. But there's so much money chasing so few deals. So we've moved a lot more of our focus to Oregon. We have some great broker relationships. We were very close to placing how much money?
In Oregon?
On the burger bill?
Oh, $6
million. Yeah. We got that close, and it may come back for us, but it'll probably be a loan of about $2 million and $2 million.
To touch on this, you'll see in a later slide, Armanino, who does our review auditing, they audit $4.5 billion in assets every year, or this last year, and $1 billion of that is centered in LA County. So and they're nationwide. So it gives you an idea of how much private money is focused on LA County. And so we have not pulled out of that, but we're not focusing the effort there. Like Glenn said, the leverage is up, the yields are down, and quite honestly, I think it's more risky.
Yeah.
and how much money.
When Dane talks about leverage, and I forgot to introduce our staff, so I'm going to do that right after this. When Dane talks about leverage is, we're scaredy cats. We go 50%. We sometimes go 60%. If we want to go 65%, we'll create a 50% first, and our profit sharing plan, or Glenn, or Dane, or some funds in-house will make the second of 5 to 15%. Well, the ruinous competition we have. There's a lot of these new funds. Either they forgot or weren't born in the last recession, which nobody really wants to call a depression, so we call it a Great Recession, because nobody wants to call that a depression. They don't get it, so they'll offer somebody 75%, 80% leverage, and it just we won't compete.
So Glenn, on the loan concentration, just a couple of fun facts. The largest loan in the portfolio is about $1.4 million, and the smallest is about $8,000.
All over. So what we try to do is diversify in turn. We don't want the fund to be lumpy. Lumpy means, in our vernacular, you've got 8 $3 million loans, and that's your $21 million worth of assets. That would be lumpy. You want to be granulated and have loans that, first of all, don't all pay off in a year. Some of them are 15-year fully amortized loans. Some of them are short-term loans. You want them diversified as far as geography goes, and you want them diversified as far as size goes. All right. Well, let me introduce, everybody knows David Tyson, former city manager.
Christy does know.
I know who you are.
Okay. Came up as finance directors for both City of Arcata and Eureka. Obviously is the perfect choice to run the fund. Works with our auditors every year. Kicks out your statements every month. Works through issues when we have them. And sitting in the back corner there is Alan Hoy, and you've all met Alan because if there's ever been a servicing issue, Alan heads that department. And of course, David introduced himself, and you all know Dane, my partner. You want to make any remarks? So what we tend to do is you'll see, wait, they made a mistake. This is the balance sheet for December 31st, 2017. But in recent years, what we do is we do a back-to-back comparison. So we're going to show you the balance sheet for year-ending 17, and then right after that, the next slide will be the balance sheet for 2018. Just want to make that comparison. Any thoughts on the 17?
Well, on 2017, of course, we went through it in detail last year. I think just as it serves kind of as a comparison starting point, the balance sheet for 2018.
Can you all hear David well?
Yes.
Yes.
Okay. Great.
Just of interest is obviously the mortgage interest receivable. It's primarily made up of the interest that is coming in this case, month of December. So as you'll see in December of 2018, it's a very, very similar number. Mortgage loans receivable, just to point out, this is the actual deeds of trust that are outstanding, less of what we call loan loss reserve, and we'll talk a little more about loan loss reserve here in a moment. So really that's it, and in 2017 we did see an increase, again, as reported a year ago, $3.7 million in owner's equity within the fund. So that's mostly new members coming in to the fund.
Okay, and here's the 2018 year end.
Yeah, probably more of interest to everybody. Mortgage interest, again, that's the interest on the funds, mostly at the end of 2018. We had a large cash balance at the end of the year, which, as we talked a moment ago, that's not a position that we like to be in. We like to have the cash out there working for you. So this was largely due to shelter or loan being paid off. And you'll hear more about shelter as we go through this. In 2018, shelter had quite an effect on the performance of the fund. Mortgage loans receivable at the end of 2018 was $10 million, just over $10 million. The loan loss reserve was about $256,000. So those are netted in that number to bring it to $9.8 million. The real estate owned, those are the 5 real estates that are owned by the fund. The accounting anomaly here is that we do have to report within this number both Glenn's share of the ownership of that asset as well as RFMI's share. That's how the accountants want to show it, and then we show Glenn's share of that down here as part of the equity in the fund. Just make things complicated. We like to do that kind of thing.
So we'll talk more about that partnership
In a moment.
So
You wanted to talk about Lee.
for clarification, David, the REO, the real estate owned line is closer to $4.1 million because Glenn's share is close to $1.4 million.
Correct.
Okay. Well, Lee is an REO we have in Sacramento. Glenn, I guess recently met a great broker in that area. Her tenant moved out and listed it and should close next week.
Yeah, she sold, she's recommended by my commercial broker. Although I'm a broker, Dane's a broker, I don't broker. I own stuff. You probably don't handle your own legal work either.
Try not to.
You're right. So, and she sold 2 homes that I bought, Shelley and I bought when we exchanged out of something else, and did a fantastic job about 2 years ago and got us into a property in Healdsburg. The point is that I remembered what a job she did. She did a great job here. The issue with Lee was she was an elderly woman, and I was not going to evict her, period. And so she left on her own volition, and we just painted, we had fixed it up, painted the inside of this condo, and got it sold quickly. So it's due to close July 1st. Okay, and all contingencies have been removed.
And we should realize about $40,000.
Yeah, we should profit from that. That's exiting our REO, real estate owned profitably. That's our motto. We get to be able to do that. We'll talk a little about why banks can't do that. But we'll mention that.
And then just the increase in the CVG2, which is Glenn and RFMI's additional contribution to that asset.
And we'll talk about that at length.
We'll talk in more detail.
Now we'll move over to the P&L. Anything?
Well, just to remind everyone, last year with 2017, we had an interest income of just under $1 million within the fund. I think of note, and it'll be of note in 2018, the management fees here totaled that that is charged against the fund for managing the fund. Management fee totaled $16,000 in 2017, and that was a reduction over the prior year of 2016 of about $60,000. Repeating things that you heard last year. We also used about $40,000 in loan loss reserve to bolster the yields to the fund members. Income was higher by about $138,000 over 2016. So that's a repeat of a year ago.
Right. So this is a good stopping point to tell you about those issues, the management fees, which went up this year, and that loan loss reserve, which was probably well over what we need. If we didn't disclose these things to you monthly, which we do in our memo, that would be called a Ponzi scheme, okay? So there were fund managers, one in particular I was looking to merge with and did not know he had problems. He came to me to merge. Was not disclosing to his clients that he was loaning money to bolster from another fund to bolster this, and he thought he could fight the SEC, and he lost, and he's in jail now. And there are other examples of that. But the point being that that's why you get a full disclosure. If we throw in some management fees or we throw in anything else, you get a full disclosure of that. Let's move over to 10. And a little bit more income this year.
Yeah, Dane's been out there hustling and getting us more interest income, so that's obviously a great thing for the fund. The increase in revenue also was due to this the closure of the shelter loan. That generated about $246,000 of income that had previously not been. It had been earned but not recorded, and I don't want to get down into the accounting weeds on that, but it was being tracked, it was being accrued, but it was not being shown as earned income. We've now showed it as earned income. And to take a step back from that is when this was all going on and we were closing on shelter, I spent a lot of time with our accountant/auditor on that to be sure that it was being handled right. And when they came and did their they didn't come here, but when they got all the information from us on their review, they went through that specifically to make sure that I handled that correctly as we accounted for it, and they were good with what we did.
Yeah,
no
we wanted to make sure that we hadn't it and reported it in prior years, and then our double dipping and reporting it again. So I didn't want it. David and I did not want it on the income statement until they went through it. So we waited for them to go through their auditing process, and they said, no, you have not earned it yet. You can earn it now.
So again, on the management fee side, there was a little higher management fee this time in 2018, about $53,000, an increase over 2017 of about $36,000. However, the fund still waived nearly $106,000 of management fee. So.
Okay, so you say, well, how can you guys survive? You just waived $100,000, and how did you build this office? Did you use our money to build this office? The answer is no to both. We have several sources of income, and really it's portfolio management income and earn fees up front on loans. We earn and share special servicing with you, which is prepayment penalties and late charges. We do get modification fees, which we pass through for loan extensions and things like that. We're doing okay. Okay, this does not trouble us. Our goal is to obviously we were more successful. Our goal was we don't want our fund below 7. We do an analysis every month, and if we think the yield would drop below 7.25 or 7.05 or some number like that, we'll kick in a little. But we haven't had to do much of that this year, and we suspect we'll do less of it this year.
And just finally, the net income is higher, again, due to all Dane's heavy lifting. Since he's the new boss, I have to be really nice to him.
By the way, this office was the last of 5 initiatives over 5 years, and then the final one will be passing the torch over the next few years to staff. I'll always remain involved, but when the idea was that when I left town, I didn't want anyone to think that Reprop left town. Reprop's bigger and stronger, and that was the impetus. But it was the last thing. We were in a hovel for many, many, many years, as many of you saw there, and watching people get pull down the stairs in zip ties from probation, and we just sort of saved for this. We just saved and saved and saved and got the computer systems that we wanted and staffing where we wanted it, and modernized we changed database managers, what we call CRM, client relationship management software. We went through all of those, and those were all very expensive and time-consuming initiatives. So now we're to our historic profit. And what you'll notice is the most profitable year, in gross volume, was 2009. And that's when we had a line of credit. A credit facility of, it was actually it never hit 50 million, it hit 42,500,000. And in that year, our net income was $1.6 million. And the delta between the two is rather large. And that was, we were earning huge bonus management fees, and we were paying a lot of interest. It was good stuff. For every dollar in interest we paid, we earned $1.25, so it was very, very profitable to borrow money and loan it at a higher rate. And so then you'll see that we've really narrowed that gap down, and right now our gross revenues are 1.5 million or 1.46, but look at where our net income is. It is not that far away from where it was, and we suspect we will keep it lean. We'll add some credit, that'll help, but there'll be some more interest expense, but we'll be as profitable in terms of gross volume, net income as we used to be.
Well, just in that example you used, in the past, we were, with the high and the low, we were at 37% of net income to gross revenue. Now we're at 78%.
Pretty efficient.
I would just add, we waived roughly 106,000 management fees, so that still puts us at a net income, if you were to factor that in, of over $1 million, which is still a good ratio.
So now we'll turn to our historic yields, and you see this monthly. We go back, how many months do we go back? A year, okay. So what we've done on this slide is really gone back 2 years so that you can see the full effect. And obviously our yields are maintaining steady in the sevens. We're going to compare ourselves in a moment to other funds, so you can see where we stand relative to other funds, because Armanino actually audits about 100 funds, and I'll talk about that a little later because we will, I don't want to jump ahead too far. So in summary, we're expecting the yields to stay in the mid-low sevens through the year. It's pretty boring, but you like boring. That's what our motto is, we want to be boring. And we may continue to waive some fees. I don't think as much as last year. And we have added to the loan loss reserve $227,000, which is way more than we probably need to have in there. We hope to, the benchmark in our industry is 3%, right? We're at what?
1.5.
1.5. But our auditors tell us we don't need that because of our track record.
Glenn, so is a loan loss reserve a discretionary amount that you and your judgment set, or is it set by some sort of industry standard or ratio? Or?
Great question. No, it's set. It is based. It must be sound from an accounting point of view. Okay. So our auditors and reviewers, they need to sign off on what we're doing. And right now they believe we have more than enough in there, and that's a result of shelter. And we've got a couple slides on, or at least one slide on shelter. explains how we get out of messes profitably. Really, it's manager for manager. A lot of the funds will tolerate losses more than we will, and they need to have a loan loss reserve of maybe about 3%, because they'll take a loss or two a year. But we don't, so we could probably whittle that down. We've had a loan loss reserve of less than $50,000 for many years. Great question. I'm going to move to the Armanino slides, and I'll talk a little. Dana will jump in. We'll talk about this. So first of all, let me give you some history. In around 2005, through the California Mortgage Association, they allowed me to form a securities focus group, and in that securities focus group, we had a subset of pool managers. And the reason I did it was for the sake of lowering our costs and for sharing information. It's the only closed door, and we have members from other states as well. And as far as we meet twice a year in Las Vegas, I moderate one in Las Vegas, and then we have one in San Francisco in May. And that's the we meet 4 times a year, but we only have 2 of those meetings. Everybody signs a confidentiality agreement. Yes, people weren't sharing when we first started this thing in 2005, but by now everybody shares, and it's really great. One of the shares that we have is we call in several of our accountants that audit most of these funds, and we ask them to do a state of the industry every May. They just finished up all their audits, that kind of thing. And Armanino took it to a new level, and I remember inviting Armanino into the pool managers group, and that helped lower the cost of these audits and reviews. So this slide here, I've got this recording thing right on top of my slide, so it's going to be hard for me to...
I can take it.
Huh?
Can we take it?
Well, I wanted to circle some things, and it makes it very difficult to... No, I can't grab it and move it, and I lost my pen. So, why don't you take it, but speak.
Sure. So the way we differentiate, we have 2 groups. Group 1 is pre-2007 funds. Those are funds started before the Great Recession.
Can you talk up a little bit?
Group 2 is post-2007 funds. Those are funds started after the Great Recession.
And the reason I set that up that way was obvious, because we wanted to track how those funds like ours did versus new funds.
So you want to compare apples to apples. So post-2007, total state countrywide, you have a high of 14.3, a low of 2.2. California is showing 12.5 of a high and a 5.3 of a low. And then all other states, 14.3 high, 2.2 low. Pre-2007, this is interesting, you have a range of 7.3 to negative 27.2. That 7.3 is us.
That's
we are
us.
the only profitable pre-2007 fund that Armanino audits, and they audit probably the majority.
Yeah, and that's probably some number between 20 and 30 funds.
So, what does that mean? Why compare the 2? Well, one, it shows that Reprop started at the beginning, is still around, and is still very strong. They've been through it and survived. The post-2007, maybe not. As you go to the next slide, and we'll see these averages. So the average for pre is 0.07. We're the only one bringing it up above 0. The post is a little concerning because they were handed a great economy. I mean, not a great economy, but a great time to start a business and start lending. I mean, you could loan at whatever interest rate you want. You could have very low leverage and command whatever, whatever terms you wanted. Now they're down to 7.7% on average. 7.6 in California, 7.7 in the country. And we're right there. We're, 20, 30 basis points off of that.
Yeah.
In our view, this is very compelling for Reprop, that we are competitive with post-2007.
Now, this is interesting, the 13.3, it is not, you go back east, you go down to Texas, and they have funds there, they are, it's the wild east. The wild, wild east. Their 15% loans are not uncommon, 17% loans are not uncommon. There isn't, there aren't, but maybe, how many private funds would there be in Missouri, for example? Like 3. So it's a different story. That's why we try to get out of state. We get a better yield in Arizona. We get a better yield in Oregon. We would in Washington. We've had loans in Washington. Did we have one?
We have one, and Nevada. We get good yield.
Nevada, right. So we'll move to our goals and challenges for this year, which is half over. So we pretty much want to talk about what happened towards the end of the year, and we're going to have Dane talk about that, because we analyzed all of our payoffs. We literally put them on a spreadsheet. We analyzed who paid them off. We made calls. We did interviews. We wanted to know what was going on, because we want to know about trends, and we want to let you know about trends. We'll talk about how we're going to continue to grow, maintain the yield. Again, more profitable markets and real estate owned reductions, noting that we profitably get rid of assets on the balance sheet. Let me just stay there just a second. So the advantage we have over a bank is that we can decide when we sell the asset. Banks under FDIC cannot. They have to do something known as mark to market at whatever the market is at that point and take a loss and sell. We don't have to. Plus, we're in real estate and we happen to make loans, so we can add value to real estate, as we'll explain a little later. And that's really, so we look at that REO on the books right now as future profit, as in the case of Lee, where we should profit to the tune of about $40,000.
Okay. So what happened last year? Received calls probably from every one of you regarding placing money.
We emailed.
Yes, text messages, everything. Last year we had 47 payoffs totaling almost $20 million. We wanted to find out, like Glenn said, who was paying us off.
Meaning, who is the institution?
Who the lender was.
Was it ruinous competition from our colleagues? Was it banks? Maybe.
So 22 of them were bank refinances. 19 were cash payoffs, usually it's a sale or in the instance of one loan. We made them a loan to acquire inventory and build up their cash flow. That worked so well, they paid us off with cash. They didn't even need a loan to do that. 4 were hard money. Those are ones that we pushed out, whether either they didn't do what they said they were going to do, or fell into default, or we didn't, we got tired of the collateral and said, you guys have to pay us off. Actually, 7 were those. 4 went hard money. A couple of them, I think, went sale. What was interesting is 34 of those we considered we served the purpose for that borrower, meaning that borrower came to us, said, I need a 12-month bridge loan, and they fulfilled, what they needed to do. A lot of times, we end up extending those because nothing typically goes as planned. Well, either based on the market or maybe just us making the loans the right term for these borrowers, they ended up paying us off in the time frame that we initially requested.
And as you can see, we asked them multiple questions, so they fit in multiple categories, because all of that adds up to a lot more than 47.
Well, a lot of these are in multiple categories.
Right.
Yeah.
So of the 22 bank refinances, maybe half of them, we served our purpose. The bank referred them to us for a period of time. We get a lot of bank referral. Hey, take these guys on, or you do the construction portion of the deal, and we'll do the takeout portion, and then we take out. I'd say at least half of those are small banks and credit unions that shouldn't have made those loans. Basically, they weren't, if they don't pass the test. Banks are not supposed to be making collateral lending like we do. So.
And then to compound that, we had a great start last year. We were on pace to break Reprop's record. Q3, Q4, smashed that. I mean, we only did $7 million the second half of last year. So, $20 million payoffs, $7 million new origination. We had a lot of money on the sideline.
We had a lot of calls.
We have a lot of investor calls, but we also looked at a lot of deals. They were just nothing we would touch. Most of them were either they wanted too much money, they wanted too low of interest rate. I mean, asking for 6%, well, no, I'm going to borrow at 6%. So just the competition at the end of last year. And we weren't the only ones. I mean, at CMA, I do ask around, hey, how's business? At the two meetings, the one in October and the one in January, everybody was just talking about how slow the market was. And even January for us was slow. February, we've picked up and placed all of your guys' money. I know some of you still have some of it, but the fund alone was sitting on $2.5 million. And Glenn was pulled out of it because Glenn acts as our line of credit. So that
I had 5 on the sideline.
So, we came out and had, luckily, been able to place most of it.
So and this is the honest to God truth, our money is placed last. So if Reprop has money, Glenn has money, Dane has money, anybody has money, we place your money before we place our own. And that's a solemn promise we make to you. Okay, ready for the next slide? Okay. Unless it's something we wouldn't let you do. And we do a couple of hairy deals.
More hands-on.
All right, Shelter. First of all, I'll do the background on Shelter, and then you can go through it. So Shelter, there's a hotel in Shelter Cove. Many of you may have stayed there, know it. And when the economy was rip-roaring, it was doing well. And then when the economy was not, we were probably underwater on the deal. And so we had some choices to make. And the choice we generally make is, if they have equity, we call them, we say, you've got equity, let's get this sold, let's reduce your interest rate, let's motivate you to do whatever you do. In this case, I wasn't sure you could go to market on a boutique hotel in Shelter Cove. So we deferred a lot of income, meaning we lowered that interest rate to the point where they could pay, then we went longer doing it, and we worked with them, and it was laborious. We'd have quarterly meetings with them where they'd come to town, and we'd go over their business plan. And actually, they've done a lot of marketing. They're part of they're in the hierarchy of the Convention and Visitors Bureau. They're trying to develop trails. So they were doing all the right stuff. Finally, it got to the point where I said, we're not underwater anymore, and we don't have to do this anymore. And so we gently nudged them onto another lender, and we slowly ratcheted up their interest rate to make them uncomfortable, to the point where they finally refinanced us out. And that's where all that unrealized income comes in, because if you're not sure you're going to get it, you can't book it. So I couldn't pay it out to you. We couldn't ethically pay it out to you if we were unsure we were going to get it, and we were unsure if we would ever get that $227,000. $270. We've given 40 of it back to you. But that's the story of Shelter. And it gives you a kind of a microcosm of how we deal through some of these problems.
And we actually helped him. I mean, he now is with a bank, and so, you know, it costs him some points and stuff, but in the long run, it's a way better option for him. He's amortizing, he's not only paying interest only, he's, you know, amortizing at a lower rate. And so, you know, while it may seem, you know, mean of us when we were talking with the borrower, no, we're actually trying to help you.
We actually introduced him to the broker. He couldn't get the loans locally. So we tried, and he had a problem with Redwood Capital. They couldn't get the loans locally. We tried everywhere there. And then we had made contact with someone out of wherever they are, Sacramento, and we've referred other deals. Yeah, hospitality, he could do these, he's very good. He's got great contacts with some boutique banks, and he's the one. So, a great story. They love us. We helped them through. So, again, I don't want to be redundant, so I won't spend a lot of time on this slide, but it is just making sure we get into the right markets. What's been good for us is that I'm now in the Petaluma market, so last Friday I drove a deal that has to close quickly in San Jose. We may not have been able to make that deal had I not had a car and could get into it immediately. So I've been driving all around the Bay Area, increasing our contacts in the Bay Area with brokers, you know, getting lunch with bankers, trying to join groups to get our Bay Area business up and greater. And that deal in San Jose, it's wonderful. It's a piece of dirt, 8 acres, that's probably worth $7 or $8 million, and we're going to make a $2-something million loan against it, and it is situated unbelievably well. It's going to be a hotel property. It's being converted, and it's just below Silver Creek and Silver Creek Country Club, and there's not a hotel anywhere close to that venue, and it's a huge wedding venue. And then during the day, it's in Eden Valley, and I can go on about it, but that's boring. Not to me, but to you. As we've talked about it, we are going to sell our assets profitably. We are currently have one partner. I have one partnership with you, and that's in North Carolina. I'll be there a little later next month, and we'll talk about that. And then we're moving on to the 2 other large pieces of collateral. And let me just move to this slide here. So Anderson is one that Dane's going to talk about. And Dane's taking an active role. We're building houses in Crescent City, believe it or not. And we're going to do that profitably. Linville Falls is my baby and my curse to bear and cross to bear. Davis is in Reading. That's the next one we're going to talk about. There's a little Shelter Cove lot that we never got around to it. We need to go clean it up. It's $32,000. And you heard that we're selling Lee. Lee is not going to be here anymore, and we're going to start whittling this down. This is, just so you can, and those of you on the phone, I'm going to try to describe this. There's a brand new, this is, when you come into Reading, if you turn right immediately there used to be a really good market there, and now it's changed hands. The good market, they built up the street. So this is at the crest of the hill, right at the top of the hill before it drops down into, I can't remember what street that's called, but this is Buenaventura Street. And that new shopping center across the way has a Starbucks in it, and a very upscale market. I can't remember the name of those markets. They have them. You know anybody? No? Okay.
I know. They're great. Great markets.
But yeah, it is. And so we own this strip of property across the street. And you see that bare area across the street there, that's the city's old fill, and it's been capped, and nobody's building on it in 100 years. And just beyond that, if you look sort of towards the top of that dirt, you see Mount Shasta, and then if you look just down towards the right a little bit more, there's Mount Lassen. So our properties have unobstructed views to those two mountains. And when times were tough in Reading, I said, let's go put a map on this thing. And because we were probably the only person to show up in the planning department that year, you know, and so we've got an engineer, and I said, let's get at least 7 lines, meaning subdivided 7 we can develop, and our engineer that I hired, based on one of our investors who's done very well over there as a developer, he said, I can get 10 lines there, I can get 10 lots. And so we did with minimal conditions. And so there's not much to report because it's been sitting, but Dane has now taken an active role with our engineer over there, and we're going to try to rezone all of this residential. It's now service commercial. We could put doctor's offices and all of that, but residential is a use that we could go to, and that's what's hot right now. And so what we probably end up doing is recombining all those lots and selling it all as one. But the neat thing is no matter what we do, nobody's going to say boo if we reconnect lots. You know, nobody cares if a doctor needs 2 acres.
I've been working with the engineer and looking for a broker. We've communicated with one. The good thing is the city of Reading is very receptive to development and to housing. Every county is short on housing, and so he thinks that we have a strong chance of getting that rezoned. What we need to do is basically present a plan to them of what we're going to do, and they do it all at once. Ken, who may be our realtor, has a lot of developers that he's putting the word out to, so we will probably get this on the market here pretty soon. Whether or not we have to do any sort of soft development, we may. So we're trying to find a borrower who will take it out right now.
Yeah, we'll glad to finance it for him.
What's happening with lots 1 through 5 then?
1 through 5 will remain commercial because it's more or less across the street from the market, and we just haven't marketed the property. We've been waiting. We didn't want to. Marketing property at the wrong time leaves a stigma on your property, and so we were waiting for the right time to get active on this one.
I was just there a couple weeks ago. If you like strawberries, there is a vendor on Lot 1. So.
And when he's not selling strawberries, he's selling something else all year long.
Strawberries with a buzz?
Okay, so let's move to Crescent City. We did the dirt development loan here, and then we started doing construction loans for a guy named Jake Anderson. What Jake was doing, and he was a green builder, he was using green building materials, but he also took that literally, and he was converting the garages to grows. So we would have his contractor, who I met with after, he'd get it finalized. Then they'd put a grow room, they'd convert the garage and black out the glass on the there. And Jake was having people, and we didn't want him to keep these properties because we're not in the business of him running rentals. He was supposed to be selling them. He sold one and then got massively busted in Willits and went to jail. And I've conversed with him since then, and since he's gotten out, because he put his aunt on the line on a loan using his aunt's house, and we've been very kind to his aunt, and we want Jake to now pay that loan off and not let his aunt hang out there. Another story we can talk about over a cocktail. But these are the remaining lots that we have. And to sell a lot, which we've learned everywhere, in areas that are difficult, you got to build a home. Nobody wants a lot, they want a home. And I'm going to let Dane take it over from here.
So it's actually a really nice subdivision. Really no fences between the homes, quarter-acre lots, just in Crescent City. It's actually in the county. So we've got our first set of plans approved. Just pulled the permit this week. They will break ground on Monday. We have a turnkey price of $211,000. Does not include our utility connections, water, sewer, electrical.
But that's like $128 a foot or something?
We should be all in $240,000 with all the connection fees.
Okay.
Impact fees, engineering or plans and everything. Very simple concept, open, something that sells well up there. It'll be, I call it kind of higher end track home, stone countertops, vinyl floors. What sells? And our target price is $325 to $350. So affordable. What's big up there are government programs, FHA, USDA, and VA. And we have and this is right in the price point for Pelican Bay guards.
We have 2 guards living in the neighborhood already, and we sold them both those homes. So I should mention, when we took over, 2 of the homes were already built out, but not sold yet. So those are the 2 we sold, and we then had the remaining lots.
So lot 11 we have submitted for plans, and then we will move on to the other 3. Sort of what's up in the air and how quickly we're going to move on this is what happens with California's implementation of solar. If it stays in place, we will probably start all 5. It's estimated to cost about $15,000 per house for solar. So
that's January 1 is the solar. All right.
So we are keeping an eye on that. From people I talk to, they think it'll get extended, but we'll see.
So if we start the houses, get the permits before, are you saying that?
Yeah, before December 31st.
Then we're good?
Under the old laws. Yeah.
Okay, so if we just turn some dirt and get the permits?
You just have to pull the permit, right, Tom?
Yeah.
I don't even know if you have to pour a foundation.
Okay. So we're prepared to pull the permits before the end of the year. And then moving on is the concept development partnerships. This is something Dan's handling, so we haven't done a partnership, and it's relatively small, and it doesn't impact the fund. What impacts the fund is our golf course community in Linville Falls, or in Marion. So we have set up, and you voted, those of you who were in the fund at the time, for these partnerships. And the partnerships are set up with me and other investors. So the way that works is we could buy as much as 60% of the asset at adjusted cost basis. Why is that important to you? The property may not be worth adjusted cost basis, but the partner pays me so for taking that risk. What it does is, and I'll get into more depth, it frees up cash for other investments, and then future expenses are split between the fund and whoever the development partner is. As I said, we can sell up to 60% of the asset, but it was a 30% minimum buy-in, and I bought in the 30%, half of what we could sell at adjusted cost basis. And we formed the entity RDLG to manage that, and so that's what we have going. The water flow, I kind of explained how it works, but if why haven't I invited other investors in? I still think this is way too risky for me to ask any of you to move into it. If I get some momentum going this summer, and I can do some projections, I can't do projections right now. So if I can't do projections, you know, I'm not going to make them up. So, but if I do invite other investors in, it'll be first to members of RFMI, and then it'll be to other Reprop investors. So the waterfall, or what we call of net proceeds, is first the partners will get their money back at the adjusted cost basis, okay? So then the money I put up to buy that share goes back first. Then a return on the partner's share, then to RFMI's investment, and finally to a management fee. So all these plane trips that we take back and forth, yes, RDLG pays for some of that, but doesn't pay all these expenses, doesn't pay any of my time. And this is, as these guys know, probably no less because I spend mornings on this almost every day, it takes a lot of time, especially since I have such a lame property owners association. I had to fire I have no right to fire the president, but I fired him. And the others were relieved. They were pissed at me to begin with because they golf with him all the time, and they still golf with him, but they realized he had to go. There are some massive problems that if you want to talk about them later, I don't want to get into them now, but they're political problems. We need to raise the dues. We need to do a number of things. We need to get our reserves in order. And that's important for us to exit this thing as well, that we show that and for me to sell things, that we show that there's a viable property owners association. So then we get our 8%, and then we split the balance, whichever split we have. In this case, it's 30-70 right now. These are the dollars that I have put in, excluding the $700 and some odd thousand that I've had to pay to buy the first 30%. So it's a little under 1.5 million. You have put in the same amount, okay? You, through RDLG, have put in the same amount. So we've each put in $748,000. Now, this year, what will happen? Well, we're building 2 more houses. Oh, let me first show you where this is. So, I don't know, you on these little computers probably can't do it, but we're in the Blue Ridge Mountains. We're near Asheville. Asheville's down here. Everybody knows. If you don't know where Asheville is, you've got to go visit it. Okay, it is. That's where I fly into, so I spend the first evening there, get a good meal, and then I'm off 50 minutes out into where the Star is. But I'm close to the hill where there's Banner Elk, there's Boone, there's Blowing Rock, there's Grandfather Mountain, all those things you've heard about, and many of you may have been out there. It's just gorgeous country. Boone is where Appalachia State is. A lot of people who follow sports follow that school. It's not a little school. It's a mid-market school. That's where we're at. That's our subdivision. This orange area up here is bulk land, Billy Goat property that I had to sell to the same guy that bought the golf course for twice as much as he should have paid for it. GE Capital was selling golf courses at $500,000 for an 18-hole golf course. We got $1 million for ours because he was abusing IRS code at the time and was putting conservation easements on land that really shouldn't have them. I think we can buy this back from him for a trail system for what he paid $147,000 for it because it was 147 acres. But the point being is that he is out of that business because the IRS threatened him, and he can't do any more. He's sworn can't do any more of those. That's what our fold-out map looks like. Here's some of our print collateral. I'll pass it around. You guys can all take a look at it. This is our trifold that we've got everywhere. And that's what we're selling now. So if you go back a slide, you can see we own all of this land up in here, but it doesn't have all services to it. So we are selling the land down here. And towards that end, everything in green, everything in white down below has been sold to third parties, which is a problem I can discuss offline because I want to make sure I get this done by 5. And if we have time, I'll explain what we're doing to get the white guys out of there. They only pay $440 of dues a year. They're not motivated. They're causing a dead ecosystem. I need them to be perturbed enough to sell their properties or option them with me and put rooftops up. The more rooftops we got going, the better we're going to exit, the sooner we're going to exit, the more profitably we're going to exit. So the green is our lots, and then these orange, yellow ones are lots that we've optioned and treat like our lots. So we've done last year what we said was we're running down this list, and these things are all done now. All of these things are done, but we still have to prove the concept. And I'm running through these slides quickly. Stop me, ask questions, say, wait a second. So the first house we sold at a profit. It's a gorgeous home. And I stay in it, vacation rental, so when I'm out there and they're not there, I stay in it. These are these little Juliet balconies that look over the golf course. Another set of pictures here shows you the house and some of the detail. This is our upper end finish, and we wanted to do 2 houses with our upper end finish. We're doing 2 more houses with a more modest finish. And so we sold this for $389, which was only $183 a square foot, but we profited from it to the extent of about $41,000, which wouldn't cover the cost of that lot. I should have been able to sell that lot. I will be able to sell that lot at maybe $80,000 or $90,000. The subdivision has all services underground. It has its own sewer plant. So the second home was, at the time we were discussing this with you, it was pending. Last May it was pending. Now it is sold, and it was fully furnished. And then the folks didn't want all the furniture. They just wanted a few pieces. So I and Shelley ended up buying this furniture package at the same cost that we paid for it. That's our dining room table in our little condo in Petaluma. That's the bed frame in Hannah's room, our daughter's room. This all sits in kind of a room that I guess would have been for a little baby's room right off the master. We had a house to furnish in Petaluma, not knowing that we were going to sell our house in Eureka so quickly. This one we took a loss on, $40,000, so we've broken even on the first 2 houses, but we've been able to get storyboards and we've got sticks going in the air. The 2 we're building now, one's called the Piney Creek. This is a 2-bedroom, 2-bath house with a big sleeping loft, and it's right next to the Watauga. That's this house. It's right to the right of that house, and it is the rough-in cost was $128 a square foot. The finish will be $60. It's still a sort of an upper end. All in at $188. Add about $10 a square foot to that for things that we paid for outside of that, tap fees, that kind of thing. And that's the Piney Creek as it sits now. It looks a bit better than that now. That rusty metal is all been evened out like our sign is now. And the landscaping's all in. The next one is another plan that we purchased from Moss Creek. They are in the southeast. It's so great to deal with, and they'll modify their plans for us, and we're paying, I think, $2,000 to $3,000 for a full set of engineered plans. This house is a 3-bedroom, 2-bath house. It's costing $139 a square foot to put it up. It has a little bit more frills in it. The finish is 63, so it'll be all in at 202. We feel this is a product we'll get about $250 a square foot from. This is the home. It's I wish this picture was bigger here. This was this winter. It's got an incredible view, and we own all the trees in between that and the mountain across the way. That you can just you can see this mountain over here, there, and you certainly can see it here with the snow covered. It's set down. It's a beautiful house. We put it right next to a lot that we sold, where someone did build a house, and it's next to another great house. So it's an area we're really trying to get some momentum in. So that is wood. It's notched wood. So what we did was paint that. So it's notched in, and where we painted it, we did the same thing on the Watauga. You can see it kind of here, that wood right there. We're trying to get a little bit of that siding on everything because it gives it that cool mountain look that these folks that are younger that are buying these houses want. So this is really our closing slide. Last year, we showed you this. This is what we showed you last year on our closing slide. And now we've built this out. I think what we will do is we've never advertised in any way for investors. It's all been word of mouth. But I think we're going to put a page up on our website. We've talked about tombstone ads. We're still on the fence there. The best advertising we have is that 13-foot sign out there that the sign maker hates us now for it. Why would he hate us? It's the most recognizable sign in town. It's second to what's her name sign, that Lost Coast sign, which is just killer sign. And because the city of Eureka is running through its sign ordinance now, and Jeff says now they want every sign to look like that. And he says, I'm trying to convince them that not everybody can afford to put that sign up. Mm-hmm. So that's really it. So we've come to the end of the show, 11 minutes early, 10 minutes early. So I don't know if you have any questions or want to delve into anything a little bit deeper, want to talk about anybody on the phone have any questions. Everybody's got a copy of this slideshow?
They will.
They will. So you'll all have a copy of the slideshow in PDF format emailed to you. So you can run through it and give us a call if you have any questions. So, questions? Thoughts?
More wine?
More wine. So for those of you on the phone, we are going to start imbibing and eating. I wish you could have joined us. I thank you for joining us on the phone. If any of you are local and want to stop by, we are starting our open house here at 5:15. We'll run it for an hour or two. We expect to have, we've invited all of our investors, whether they're in the fund or not. We've invited some of our borrowers here. Haven't we invited borrowers?
Yeah.
Yeah. So, there's probably a cannabis borrower or two you can ask all kinds of questions of. By the way, just so you know, I had a drink with Bob Moore last night, and we've been trying to, we have some really, if you don't have a moral problem with this, I don't, we have the best borrowers. Not only in the state, and whether they're in the fund or out of the fund, but in Oregon, in Arizona, in one case down south in the desert, And how do we know they're the best borrowers? Well, first, we know our local borrowers really well, and we vetted them using retired folks, one of which is on this call, who help us pick and choose our deals. But two of our borrowers have already gone public, have been bought by Canadian firms. The one in Portland, known as Chalice, look them up, like a glass chalice. And then Beth's operation in Arizona, and now she's director of all operations. She was the managing director at Jeffries on Wall Street and got bored. She is, her husband's arguably the biggest paving contractor in the state of New Jersey. They don't need, she raised 6 kids, retired from Jeffries, and now does this nationally. It's crazy. So if generally good business people, or we've connected them with them. So maybe you'll meet some of those. I didn't mean to get off on quite the tangent.
And Glenn, just clarification, I don't know if you mentioned Best Cannabis Borrower.
Best Cannabis.
What you were talking about.
Yeah,
Okay.
yeah, Best Cannabis Borrower. Yeah.
We do have the best borrowers.
We have the best borrowers.
Period. So for those of you on the phone, if there are no questions, we're going to exit the conference room. The bartender's setting up. We'll go from there. Okay? And if you do have any questions, just email us, Dane or I, or both of us, and we'll get replies to you. Thank you all for joining us.
Thank you.
Bye.
Have fun.
Thank you.
All
Great
right, thanks.
presentation. Have a good open house.
Thank you.